Would you bet on a coin flip? If heads came up, you won $600. If tails came up, you lost 100. Well, according to Laura from thedailyworth.com, that's exactly what it's like to invest in derivatives. A derivative is a piece of paper that's value is denoted by an underlying asset. So an example of this would be like a home loan. A home loan itself is just a piece of paper. It gets its value from the house that is actually under it. You know, if the house's value goes up, the home loan is technically worth more. If the house's value goes down, the home loan is usually worth less. So few people actually use derivatives in investments, even though they're a huge part of the finance community. Very few investors actually take advantage of them. As a student of finance, I've been taught much about derivatives over the past couple of years. Many of my classes have devoted significant amounts of time to the study of how derivatives work and why they work. Also, personally, I've been invested in options for about 2 years now, and I've done pretty well. So I think I have an understanding of how they work and why they work, and I'd like to also give you guys the opportunity to understand how they work and why they work. So I'll be talking about the two most common types of derivatives traded by investors: futures and options. A future, according to the Economics Times, is an agreement between two parties to buy a certain asset at a certain time at a certain price. These can be quite risky because the underlying asset, as it goes up and down, the value of the contract will also go up and down. And usually they're leveraged very highly as well. So you only have to put 20% down. So you only have to put 20% of the underlying asset's value down when you actually make the contract. With the high risk, though, comes high reward, and this is how people make money from futures. It can start getting complicated when we discuss how these actually interact with each other, so I'm going to go ahead and give you guys an example real quick. As you can see by the graphs, as one side goes up, the other side goes down. The example that I'd like to use is gold. Let's say that you entered into a contract with someone that said that you would pay $1,000 for an ounce of gold no matter what, okay? And he also did the exact same, so that he would give you an ounce of gold for $1,000 no matter what. Well, if the ounce of gold goes up to $1,500 on the open market, once that future comes due, you have just acquired an ounce of gold for $1,000, and then you can immediately turn around and sell it for $1,500. That's kind of how it works. As you can see by the graphs, as the value of the asset goes up, the person who is buying the asset makes more money. As the value of the asset goes down, the person who's buying the asset makes less money, and the inverse is for the person who's selling the asset. Okay. Now, I'm going to talk a little bit about options. Options are exactly like a futures contract, except that one person is not incurring obligation. So, according to Investopedia, an option is where you agree. So, according to Investopedia, an option is where you agree to buy a certain asset at a certain time at a certain price, but only one person is actually incurring the obligation to go through with it. Because of that, the party that isn't incurring any obligation usually pays a certain fee up front. Okay. So, for an example, these are a little more complicated than futures, so I'm going to use a little bit of a longer example. Let's say that you agree to purchase an options contract for $1. The contract says that a company must sell you a stock of XYZ for $100. Okay? If you decide to exercise it, they have to sell you XYZ for $100. Then let's say that the price of XYZ increased to $105. Well, now, if you exercise that contract, you would actually make $5, but you only put up $1. So your return on that investment would be 400%, okay? As opposed to if you had just bought the stock regularly, your return would have been 5%, the $5 out of 100. So this is a way to get an extreme amount of volatility out of an asset that isn't necessarily very volatile. On the flip side of that, you can also do a put option, which is the agreement to, no matter what, buy the company that you have the option with must buy that underlying asset for a certain amount of money, no matter what. Now you can see here, the graph just looks exactly the same except for flipped. Here, as the asset loses value, you get more money from that contract. So let's say that XYZ fell to $95. They have to buy it at $100 no matter what. So you can turn around and make a $5 profit on the company losing $5. But your $5 was on one single dollar investment, which means that you made 400% profit. Okay, so you can see that it's a very volatile situation. Now, if you look at the graph, it actually levels out at the bottom. That is because you can only lose what you put in. Let's say that the value of the company increased to 105 when you had a put option. Nobody would be willing to give you any money for that contract because it's no longer worth money if you exercise it, but you only lost $1. So you would lose 100% of the money that you put into it, but you have a chance at getting a large amount of profit. So that's kind of where the whole betting deal comes into play. Okay, so those are the, excuse me, those are the two separate scenarios, and you can see that all that derivatives are injecting volatility into an unvolatile asset. Okay, so basically what I've showed you today is the two most common types of the two most common types of derivatives: futures and options. What I'm going to hope that you get from this lesson is peace of mind when you go to try and invest with these. You can make a lot of money off of them, and they are very underutilized by most investors. So what I want to do is kind of open up information so that people are able to make more informed decisions when they decide to invest with derivatives, and give them more confidence in investing with derivatives, because they can be great ways to actually maximize profits on your portfolio. So thanks for the time.